The Federal Reserve cut the federal funds rate and mortgage rates actually went up. So, what happened? The answer lies in the bond market. The 10-year Treasury yield and 30-year mortgage rates have trended together since 1971. And the bond market is not as slow as the Fed. In fact, it moves much quicker. And for months, it has been sending 10-year Treasury yields and mortgage rates lower in anticipation of a series of Fed rate cuts, not just one or two. The key to understanding mortgage rates is to focus on labor and economic data and not rate cuts. The 10-year got as low as 3.6 before the latest housing starts data came out. Housing starts beat expectation, and the single-family home permits data shows that they are growing again. The growth of housing permits is a good sign for economic expansion, and falling mortgage rates since June have definitely helped. However, we would not have this conversation if mortgage rates were still in the range of 7.5% to 8% today. So, once again, the bond market got ahead of the Fed and pushed bond yields and mortgage rates lower. Recent jobless claims data has come in better than expected as well, sending yields higher again, which looks perfectly normal. The bond market is so far ahead of the Fed, in fact, that it can sit, watch, and see how the economic data trends. If housing starts, industrial production, and jobless claims were worse than expected, we would have a totally different discussion today. However, that's not the case. Even recent retail sales came in higher than expectation. So, if you're confused about why rates went up, remember that the bond market gets ahead of the Fed. The labor market has been softer since the end of 2023, and the Fed is only now worried about a risk to labor. This means they need to play catch up to the market pricing. The 10-year Treasury yield is at 3.373 at the time of this video, which is up from the lows from 2 weeks ago. For mortgage rates to go lower, we need to see these three things. Number one, mortgage spreads getting better. Number two, economic and labor data getting softer. And number three, the Fed getting more dovish with their comments, showing a willingness to help the economy stay out of a recession. I hope this helps you better understand why mortgage rates went up when the Fed made rate cuts. As always, reach out. We're always here to answer any questions that you have, and we hope to hear from you soon.